Section 1, Introduction. In this section, we're going to be looking at what accounting is all about, why we have accounts in the first place, what they're trying to tell the world. So, who produces them, when are they produced, why do they exist, and what are they trying to tell us? And we introduce the basic ideas, our main three statements of the balance sheet, income statement, and cash flow statement. First of all, who should be doing this course? Who are you watching this video? First of all, you may be doing an exam. This could be an accounting exam such as ACCA. It could be an analyst's course, IMC, the Investment Management Certificate, or the Chartered Financial Analyst program. And for both of these, for ACCA, you're going to be learning a lot about accounting. That's the main focus of your exams, and this will probably be at the very early stages of your studying so that you get a good introductory grasp of how accounting works. If you're looking at IMC or the CFA program, then this may be, you may have started the program, you may be thinking about starting CFA program, for instance, and this is going to give you a good background in order that you can study the financial reporting and analysis sections of both of those exams with confidence, knowing that you've got the basics under your belt. It could be that you deal with this in your day-to-day life. You're working in an accounting department, or you're working with accounts or accountants, and you need to understand the terminology, you need to know what the numbers mean. Or it could be that you're thinking of moving into a job where accounting is an important part of this. You want to move into finance or accounting, and you want to know what it's all about. This is purely for background knowledge. What are you going to get out of this course? The main thing, what are accounts, why are they produced? We're going to cover that very shortly. The main components, I've already given you a list of the three main statements. The balance sheet, the income statement, and the cash flow statement, how do they interact? And what are the other statements, what are the other components of accounts that are slightly more complex, slightly more detailed? How do we interpret the figures? If you see some numbers, it's all very well saying this is the definition of a number, or even this is how the number was calculated. But how do we interpret this? Do we want a number to be particularly big or small? And we're going to start looking at some ratio analysis on this. And then finally we're going to be looking at some of the choices that managers have. If a manager decides they want to make a company look more profitable, you will be surprised how easy this is for them to do that. Accounts. Who, when, why, and what? Well, let's start from the very beginning. Almost the what. What are accounts? What are they trying to do? We're trying to demonstrate what a business has been doing over an accounting period. An accounting period is typically a year, but it doesn't need to be a year. And most businesses produce them regularly. If we're dealing with a company, a limited company, so in the UK, LTD for private limited company, or PLC, public limited company, it could be incorporated in the States, it could have all sorts of other acronyms after the name in different European and international countries, but every company must by law produce a set of accounts every accounting period, normally every year. And these accounts are designed so that outside people can have an idea of what's going on. We'll talk about that a little bit more as we move through these early sections. So every company must produce a set of accounts. Who's responsible for it? Well, the company and the directors that are running the company are responsible. Often you'll find for smaller companies that accountants do the work. Sometimes the auditors are even involved in it. But if you've got accountants putting this together, they're doing the number crunching. They're putting the numbers together. They're building the financial statements that at the end of it they can say, here are your accounts. But it's the director's responsibility. The directors of a company are responsible for ensuring that the accounts are produced and published within the suitable timescale. When must they be produced? I've already said accounts need to be done every accounting period. So every year end, if a company has a year end at the 31st of December, they would need to show the accounts for that financial year. Of course, there are 364 alternative dates of the 31st of December. For simplicity, we'll often be using that just to make an accounting year the same as a financial year. But if you've got an accounting period, if it's a year ended any date in the calendar year, you need to produce accounts for the year to that year end date, and that must be published in due time. Other accounts may be needed as well. For example, in the UK, a company that's listed on a stock market needs to produce interim accounts. So all companies on the London Stock Exchange must produce interim accounts that show the first 6 months of each financial year. So if the year end is 31st of December, they will show interim accounts to 30th of June, and then the year end accounts to 31st of December. If a company is listed on the New York Stock Exchange, they need to produce 4 lots of quarterly accounts each year. So depending where a company is listed, depending where a company happens to have its shares based, then there may be a different frequency of accounts required. Now, regardless of whether a company is listed, regardless of whether we may be able to buy shares in this public company, all companies must still publish accounts. And just to give you an idea, in the UK, there are several million companies. And of those several million companies, most of them are tiny. For example, a lot of companies may own the freehold of a property and do absolutely nothing, may just have 3 or 4 shares and be dormant from year to year. Other companies may be set up by one person who are acting as a contractor. So you may have John Smith, who's the contractor, but he is employed via John Smith Limited. And so there you have a one-person company. There are many other examples, but a very small number of companies are big enough for most people to have heard of them. Literally 1,000 or 2,000 companies are fairly well known and are listed on the stock exchange. The vast majority of the 2 million companies in the UK are tiny and very few people have heard of them. But they have all still got to produce their own accounts. So every company, whether it is on a stock exchange or not, must produce yearly accounts. Why they needed? We need to see what's going on in the company. Now, specifically, there are many stakeholders involved. When you think about a stakeholder, the word stakeholder means a party that has an interest in how a company is doing. Now, the number one stakeholder that we normally think of is the shareholders. The shareholders own the company, and the shareholders are the primary people for whom the accounts are produced. So when you look at the accounts, if you read it in detail, it will say to the shareholders of this company. That is their main audience, that is their main purpose. However, the wider stakeholders, there may be very many other people who are interested. Who do you think might be interested? So who else do we have? Just sort of scratch your head and think who else might be interested in how the accounts are doing. Well, you've got the employees, they want to know if they're working for a safe company. You've got the directors, they want to know if their company that they're managing has got good accounts. You've got the government, they want to see if the tax is appropriate. You've got the customers to check that the company that's supplying their goods is reputable. You've got the suppliers to make sure that their invoices are going to be paid. You've got the whole environment, you've got the people in the local neighborhood that are potentially helping the employees of the company. It's a very wide range. A lot of different stakeholders are interested in the accounts. And when you look at the accounts, they are read by very many people. However, their number one target audience, the people the accounts are written for, are just the shareholders. Now, there's one very important stakeholder that I haven't mentioned, and that is the analyst. Maybe this is what you're going to be doing shortly. The analyst is someone who wants to analyze the accounts, understand what's going on, and maybe use that analysis as a recommendation. Do we want to invest in this company? Do we want to advise our clients to invest in this company? But in any case, where all these different stakeholders are looking at the same raw materials of the published financial statements. What are included? Now, if you get a small private company, the accounts could be literally 3 or 4 pages long, and they're going to tell you very little indeed. Now, we're not so interested in those, although they are the biggest number of companies. They're less likely to be something that we want to analyze because we're less likely to be dealing with them. We're certainly less likely to be investing in them. The companies we're interested in are the larger companies, probably those with the shares listed on a stock exchange. And what you'll find is company accounts can be enormous. If you think of any company you like, and in fact this is quite a good exercise at this point. Think of any company where you think the shares are investable, so you think you could buy the shares. It could be your favorite shop, it could be a supplier of goods that you purchase online, whatever it is. And look up the company accounts for that company, and we'll start to think about what's included in them. So think of whatever company you want, If you want, pause this course or pause after we finish this first introductory section and go to that company website and see if you can find the accounts, or simply search online for that company accounts and it will come up fairly easily. And you will find that these accounts can be quite a large document. So if you take a large retailer or a large internet provider of some form of service, you will find that the accounts could be hundreds of pages long. And although these days most of them are simply soft copy or online, you do still get a lot of printed accounts. A lot of the companies with much wider, smaller groups, smaller shareholders. So, for example, if you look at well-known high street retailers, they may have a very large number of small shareholders, and those companies are more likely to produce a big glossy brochure. And if you saw that brochure, the first thing you'd think is, this is a marketing document. This is a document that's saying how wonderful the company is, lots of pictures of happy, smiling customers. We love this company. We love spending all our money in these shops. But what they're doing, if you start looking through the accounts, you will see that, yes, in between all the happy, smiley customer photos, you will see there's lots of detailed information, lots of schedules, lots of description of what the directors are doing, and you'll find the main components, the main statements, which are the balance sheet, the income statement and the cash flow statement. Now, those will typically be part-way through the document. You will find that before that, in the earlier pages, are lots of description of what happens in the account, lots of descriptions of what's happened in the year. There's a letter from the chairman. There are documents written by the directors. There are descriptions of the directors' attendance at meetings, at the company's approach to environmental, social, and governance issues, depending how big the company is, even how many meetings each of the directors have attended. You then have an auditor's report, and we'll talk a bit about the auditor later. And after that, you have the main statement of the balance sheet, which says this is what a company's position is on this date. So, for example, on the 31st of December last year, this is what the company's position was. This is the financial position of the company. Secondly, the income statement. This is what has happened during the year. All the revenues, all the income coming in, all the expenditures, and therefore the profit. And so that's showing what's happened during the year. Thirdly, the cash flow statement. This is saying what money has come in to the bank account, what money has left the bank account. Similar in many respects to the income statement, but we're going to be identifying in a lot of detail what the differences are between those two statements. And then after that, you have lots of other notes, lots of descriptions, and there are all sorts of other statements as well, some of which will be referred to later on. But lots of notes, and it can be hundreds of pages long. The more complex companies, typically the financial ones, they can have up to 500 pages of accounts. So incredibly complex sets of financial statements. And each of the numbers in the balance sheet, income statement, and cash flow statement may have pages of schedules that are shown below it. So in the balance sheet, here's one number that may say property, plant and equipment, and then you'll see pages of description of what that includes, how the number's calculated, and what types of assets we include within that number. Let's get an idea of how those three main statements fit together through a timeline. So here you can see a timeline. You can see on the screen 20x1, 20x2. This is a bit of an accounting trick. 20x1, of course, isn't a real year. It could be 2001, it could be 2011, it could be 2021. It doesn't really matter. The point of it is that it's a generic year, and it means that if this example is used this year or it's used next year, the example doesn't go out of date. Now, if you're doing any exams after you've studied for this for accounting, you'll find that most exams will use real live years, so it'll be real years. But in terms of understanding the accounts, it's 20x1, 20x2. You don't need to know when that was, except that they are consecutive years. Now, if you look at the timeline, so we're moving from left to right here. You can see you've got 2 calendar years. Now, as I said before, we're going to assume the financial year end is the 31st of December. 31st of December is one of the 365 days in the year, but let's assume for the purposes of this course that the financial year end matches the calendar year end. The balance sheet is a statement on a particular date of the financial position of a company. We will see the different components of assets, liabilities and equity in detail later on, but you can see it's on a date. You can see the little red asterisk there on the screen. That is showing you that on 31st of December 20x1, 31st of December 20x2, a statement of financial position is published. That is the balance sheet. It is a snapshot view at the financial year end. Showing what's happened during the year is the income statement, and you can see the income statement spans the year, goes from 1st of January to 31st of December throughout the year. All the revenues, all the expenses, all the profits, we will see the components later on, and it's saying this is what has happened during the year. So in the same way, if the balance sheet is a static picture, it's a photo, it's a single snapshot, the income statement is, I suppose, the movie. This is what's happened during the year. It's a summary of everything that's happened from throughout the 12 months of the year, or throughout the accounting period, to be a bit more generic. The cash flow statement is for the same time period as the income statement. You can see here, income statement and cash flow statement can be for 20x1, income statement and cash flow statement can be for 20x2. We didn't put all the arrows in because it gets messy. But you can see that they are both covering a financial year. The cash flow statement says this is what cash came in, this is what cash went out. Again, we're going to understand later on exactly what that is, how it works, and how the cash flow statement and the income statement differ from each other. So whereas the income statement has revenues and expenses, revenues from the sales to customers, expenses, the costs of buying stuff, the cash flow statement says what money came in, what money went out, and they're closely linked, but they are very importantly different from each other.